the broker owner of Infinity Investments, which is a commercial real estate investment firm that specializes in syndications, brokerage, and management of multifamily apartment buildings. So Steve started Infinity Investments in November of 2009. So the other thing about Steve is that he is not only a very successful, commercial broker, he is also highly involved in the community. So he's been the past president of our state chapter, California Association of Real Estate Brokers. He has been the past president of NorCal CCIM, which is the Realtors Commercial Division, and that is a huge accomplishment, okay? And then he's also been the past president of the Oakland chapter, which is the Associated Real Property Brokers. So with that, I'm going to allow Steve to take it over and introduce himself and then go into his presentation.
Thank you very much, Dee Dee. I really appreciate that. And thank you for the warm introduction. Being a realtist for all these years, and I've been a realtist since 2004, had the honor of serving as president in the state of California in Oakland chapter, but also getting to know all the chapters. A great part about being the president of KRAB is I was able to go and travel around and really meet everyone. And I've been to your group several times and spoke, and down in Southern California. And it's a great connection of people who, we on the same mission. We are trying to push forward the Black community as it relates to all things in the housing industry, but particularly home ownership. And kind of my mission and vision individually and as a company is through commercial and investment property ownership, which is kind of the next step. And so we're going to talk about, I wanted to kind of go in today to my presentation on group investing, and I thought here's what I'm going to do. I'm going to give a ground level presentation on the importance of the fundamentals of investing, and I'm going to infuse the idea of group investing into this presentation. Then maybe sometime in the future, I'd like to come in and do a follow-up to that with the specifics on group investing. And the reason I want to take that method of doing things is because I believe you got to crawl before you walk. You got to master the fundamentals before you get into the exotic and exciting things. But that's very, very important because we're in a marketplace that is very interesting right now. Very interesting right now. And single family homes are going up. Commercial real estate, apartments, investment property are sitting. And we got an election here in what, about a month and a half now? Is it maybe less than that? We in a pandemic. It's a lot of racial, the pandemic and exacerbated the racial tensions that have been in our country for over 400 years, and all the oppression, the systematic oppression that does exist. So this is a very important time to master the fundamentals. And as I go through this presentation, I will be talking to you about the importance of group economics, about the importance of us collaborating, which is what we're doing right now. It starts with an idea, it starts with a thought, it starts with a group of people coming together and then moving together on one accord with a similar purpose and vision. And that's very, very, very critical. So I'm going to go ahead and jump into it. I'm going to share my screen here. Give me a second. Hold on one sec. Share. Can you guys see that?
Yes, we can see it.
Okay. Let's start from the slideshow. From the beginning. Bam. Okay. So we're going to talk about kind of the introduction to multifamily commercial real estate investing. And each step of the way, I'll talk about the importance of you doing this together. And I want you guys to look at this through the lens of an investor. Okay. Pretty much, I don't know everyone, but most everyone here probably is going to be a real estate professional or some kind of other professional of an independent nature. That's typically who the people who come to the realtors meetings are. I know there was a brother, I believe, mentioned New York Life, so it's in the financial industry. Whether it's financial industry, real estate, whatever it is, as independent folks, we are responsible for our own investing, and we're responsible for our own, investment portfolios, our retirement, if you will, particularly in real estate, because not how many of y'all broker is giving y'all a 401k package and they matching you every month? Probably not many. And I don't know nobody that's doing that as a broker, right? So here's the deal, y'all. As we go and we sell properties, we get other people in the properties and the homes and maybe investment properties, let's not forget about ourselves. So I want you to look at this presentation through the eyes of an investor. And if you're not an investor yet, on being an investor, we all need to be investors. We talk, Dee showed that figure about the wealth gap between blacks and whites, pretty 30% gap between home ownership, and that home ownership is one of the key drivers. In fact, it is the key drivers to wealth disparity from any group in this country for the variety of reasons I won't go into. Could you imagine if we can help folks buy a home and then within a year to 2 years buy a duplex, a fourplex, or an apartment? That is something that can be done with every single person that you sell a home. You sell a home to them, they have what it takes to then qualify within a year to 2 years to go and buy a duplex to fourplex at least. And if they put a diligent plan together of acquiring their home, saving money, keeping their credit together, they can do just that. And we can obliterate that wealth gap if we looked at it at not just selling somebody a house, but building a relationship with them that you sold their house and then you move them out. Okay. And not just, they don't have to sell their house in order to buy this other property. They just got to do some things right. Okay. And they have to understand some of the things that we're talking about. So look at that. If you're a broker and agent, understand that this is a way that you can really help people out. And then you ought to be putting a plan together, trying to buy one property a year, one property every other year, something to that effect. Let's just not help everybody else get rich off this. Let's ourselves figure out how we can build wealth within our family. So I want you to look at it through those lenses. We already talked a little bit about who I am, just a little bit about the company. We started in November 2009. It'll be 11 years in November. And so I started a company in the storm. 2009, a lot of people was making top ramens and pinto beans to get by. So I started the company at that time because I worked with investors. I was working with a firm. I sold a couple of big apartment buildings, and I was sitting here looking like, hey, if you got money and you're an investor, or if you're a broker like me, an agent who had those type of clients, I was like, people gonna make a killing because I got in the market in 2003. I seen the run up. I saw what happened in the Bay Area and everywhere, Stockton and pretty much everywhere. And so when those prices came down, I'm looking at prices under $100,000 per unit, 40, 50,000 per unit in the Bay Area, whereas they were just 200,000 a unit a couple of years ago. I knew there was value. So I say all that to you to say is as we transition into coronavirus, recession, adjustment, whatever you want to call the situation, understand that it's in these situations where the real opportunities are. But you got to know how to identify them, and you got to have the fortitude to move forward on it. All right, that's a big thing I want to say to you all as we're, I think, getting ready to enter into some pretty interesting times, kind of post-election, regardless of who wins, because there's going to be a shift in the guard one way or another, when we go in this. So we got to go in eyes wide open, looking for the opportunities and making sure we guide people the right way. All right. So that being said, I like multifamily properties. That is what I advise in terms of commercial real estate. Now, multifamily commercial starts at 5 units. So once you have 5 units and above, you are now in the commercial real estate world. 2 to 4 units, that's residential income. Okay, still multifamily though. And so for people just starting out, I think you may want to look at 2 to 4 unit buildings from a rental standpoint. You can get houses as rental as well, but with the plan of moving up to 5+ units. Okay, and I really, really, truly advise that. Other product types, office, retail, hotels, a lot tougher to get into. But if that's something that you're passionate about, go for it. If that's something, but understand, more difficult to find a tenant for those properties in a tough market, a tough economy. Not as many people are traveling in hotels. Businesses are not leasing up office buildings, retail buildings. However, people still need somewhere to live. Okay. Now, we like them because the occupancy rates are higher than other product types, historically and currently. Throughout the history of, economics, apartments going to stay occupied at a higher rate than office buildings and retail buildings. Okay. And financing is available at attractive rates. If you look at apartment building interest rates versus office building interest rates, it's going to be a 1 to 1.5% difference from what I'm seeing right now in the market. Lenders are not excited about office buildings or retail buildings. They still like apartments, even though a lot of people aren't paying their rents. Landlords cannot evict. All of that is real right now, but lenders still like apartment buildings other than other properties. Now, when the market crashed, right, prices dropped 50, 70% in some places. Rents only dropped about 5, 10% in general. Every marketplace is a little bit different. But rents didn't crash 50 to 70%. Okay. So take that lesson in knowledge. I think rents are going to soften up. We're already seeing in San Francisco, rents have softened up dramatically. We're starting to see rents soften up in Oakland. From what I'm very involved in the Stockton apartment building market, though. I haven't seen softening of the rents yet. What I have seen on some buildings is people not paying. But from what I see in Stockton, you guys' rents are still strong. And I think that's because the rents are affordable in relationship to everything else in Northern California. You know what I mean? And y'all may say, hey, the rent almost doubled in 5 years, but they're still affordable for the rest of North Cal. So that's why I think Stockton's still going strong. Plus, you have guys have a lot of positive job growth going on, and people from the Bay Area continually moving out your way. So that's just why we like multifamily properties. I advise you start there, but if you have a passion, if you have a knowledge, if you have maybe a family background in some other properties, you can take that, you can go that route as well. I'm just advocating for people to look at commercial and investment properties, not just to stay in the single family home space. Okay, apartments is what I like the most. Now, some key things you need to look at, whether you're buying a property by yourself or with a group. Now, here's what a group is. A group is 2 or more people. So if you got you and you, somebody else, that's a group. Now, if you don't have a lot of money and resources, the best way to try to start off is to look at who does in your network. Does somebody else have some money? But maybe they're really busy. Does somebody else have ability to get financing? And then another friend have some money and you have to know it all, or you have the wherewithal to put things together. That's a great way to make some things happen. Many of us oftentimes just are looking at what we can do as individuals, okay? It's time for us to start looking beyond that. And that's what we mean group economics. Guess what though? It ain't easy. Nothing worth doing is easy. It's gonna be hard, just like raising kids. We love these kids, but man, I tell you, it's a challenge, okay? Anything worth doing typically is a challenge. So, but it's the same thing that you're gonna deal with in the real estate brokerage business. I mean, you're dealing with people at the end of the day. So if you're starting out looking and you don't have a lot of resources, I advise teaming up with some people you like, and you trust. That's important. And then going as a unit. And a lot of us miss out on that. And I think that's one thing as Black folks that we can figure out how to do this. A lot of other cultures have done this and are able to be successful in buying investment properties without much more resources than we have. What they did though is came together and then started buying stuff. We can do the same thing, what I'm trying to tell y'all. Okay, and when you do so though, you don't want to just go out and buy any old property. You really have to be diligent about the way you look and the way you analyze and evaluate properties. Okay, so we look at number one, the cash flow, and then the net operating income details. Now, NOI, you hear that term NOI, that stands for net operating income. The details around that, the price and the cap rate. Cap rate stands for capitalization rate. Return on investment, return on equity, cash on cash return, and the internal rate of return. These are some measures of the return that allow you to figure out if this deal is a good deal or not. Some of the keys that we look at. And then Dee, as we go through the presentation, just let me know when we get close, when we need to be there. I'm gonna wrap it up. I can do this. I can talk for all this stuff all day. So just keep me on point as I get into this presentation.
Will do.
Now, the key in looking at investment property or commercial property from an investment standpoint is we have to analyze the income and expense. Essentially, they call this stuff income property as a nickname or another name, because really the income drives the value of the property. The income drives the demand for the property. The income is why we are investing in this property. Even if you want to take the property from nothing, bring it up, higher income, and then sell it for a profit, you still have to get the income up, which is why it is so critical. And as a broker, it's one of the biggest things that I see getting misrepresented. It's one of the biggest things I see people not taking the diligence in handling and going after, is just properly breaking it down and analyzing the numbers. So when you get a building, You're looking at a building. You want to ask the broker or the seller, if you're dealing directly with the seller, to provide you with a copy of the rent roll and the historical financial statements, the profit and loss statement. And what that's going to do, the rent roll is going to show you who is living in the building, how much they pay, what their deposit is, when their move in and move out date is. So you know what their rent is, you know what their deposit is, and how are they on a month to month, are they in a 12-month lease, 2-year lease, whatever. Then the profit and loss statement is going to show you the historical numbers. And what you're going to do is take those numbers and create your pro forma. Pro forma means projection, essentially. And you got to look in the past in order to figure out the future. So with that, we want to start and we want to build our pro forma by starting with what's called the gross scheduled rents. And that is the total amount of rent that you could earn from this building if every unit was leased out at market rate. Then you want to start taking away from that. You first take away vacancy, and you can look at the building's history to try to figure out what the building's vacancy rate is. However, you can also look at the marketplace to try to figure out what's going on in the marketplace. Like in Stockton, apartment buildings and multifamily has about a 3 to 4% vacancy rate. For commercial, it's about a 10% vacancy. Pure commercial, meaning retail, office, about 10% vacancy rate. So you would apply that vacancy to take away from the gross scheduled rent. Okay. Then if there's any loss to lease or concessions, meaning that you're going to start seeing this more. First month free, right? $99 deposit. Okay. Refer your friend, get half off your rent. Those are called concessions. And you can look at the rent roll and the numbers from the past to see they were supposed to be bringing in $10,000 a month or whatever based on this rent roll. Then we look at the profit and loss statement and say, well, they accidentally brought in $9,500 or $9,000. So we know that something was off. Somebody either didn't pay rent or there was some sort of concession. So we talked about loss to lease, delinquent payment, concessions, anything you identify from the past, you take away from that in the future. All right, you might be able to improve that though, but when your analysis, you just want to look at what happened in the past, take away from the future. Now, then you want to add what's called other income. Other income is just a generic term for income that is not derived from the rents from the property. Vending, laundry, cable contracts on bigger properties, billboards, cell phone towers, parking fees, any other source of revenue that you can bring in outside of the rents. We call that other income. And we like to look at what is. You might be able to go and figure out a way to bring in a vending machine, a billboard, but you got to analyze what is first. And then you can build that in down the line. So you look at what is by looking at the historical profit and loss statements, taking those things, adding to the income, and then that gets you a bottom line number of in terms of gross income, of effective gross income, what you actually plan to bring in on the property. Very, very important on this piece, because now what you're going to do is take away from that effective gross income by minusing out the operating expenses. Let me just make sure I make a point here. I'm talking about the cost of doing business. I am not talking about mortgage expense, all right? Mortgage expense is a capital cost, all right? What we call debt service. But what we're talking about for this purposes is the operating expense. If you pay cash for the building, there's no mortgage, you still gonna have taxes, insurance, management, maintenance, reserves, utilities, repairs and reserves. And you might even have some other things like pest control, landscaping, security, things like that. Okay, but these are just TIMR is an acronym used in the business to describe the basic operating expenses that you're gonna see in the business. Okay, and it's what operating meaning is the cost of doing business, not the cost of the capital. All right, not the cost of the mortgage. Very, very important, because a lot of people don't. Oh well, I'm not worried about taxes, insurance, garbage. What is the mortgage payment gonna be? Do that, but then they don't account for this stuff. You have to take your effective gross income, take away your taxes, insurance, management, maintenance, utility reserves, landscaping if there's landscaping, security if there's security, pest control, whatever your costs to run the business are. And then that gets you a very important number. That gets you the net operating income. Okay, again, we still haven't accounted for our mortgage payment, because the net operating income is what you use to pay the mortgage. The net operating income is how you value the property. That's how you evaluate the property, how you come up with a value for that property. All right, so you have to get there first. All right, And net income essentially is the net income after accounting for all income sources minus all non-debt service expenses. Essentially, it's what's left after you collect your rents, pay your bills, but before you pay your mortgage. That's your net operating income, okay? It's the money you use to pay your mortgage. But more importantly, it's the number we use to evaluate the property's value, okay? An appraiser is going to take the net operating income and then they're going to capitalize that in order to come up with the value in the back end. And that's where the cap rate comes in. But you do not include your mortgage payment in the operating expenses here in order to get to net operating income. It's just the operating expenses, the cost of doing business. That gives you the net operating income, all right? Now, I said this is a critical number for a lot of reasons. It's the money you use to pay your mortgage, but more than that, it's the number we use to come up with the value of the property. Because we take that net operating income and we capitalize it, okay, by applying the cap rate. And cap rate stands for capitalization rate. You'll see, nobody in the business is really gonna say capitalization rate, they're gonna say cap rate. And so you need to know what that term is if you're gonna be navigating in this business. And essentially the cap rate is the rate of return generated by a real estate investment property based on the annual net operating income that a property generates. Basically, it represents the percentage return you would get from a building if you paid cash and didn't have a mortgage. All right? It's a mouthful to explain this equation. So if the NOI is $100,000, right? And the purchase price is $1 million. So you determine through your analysis that the NOI is $100,000 and the building is for sale for $1 million. The cap rate formula, cap rate equals NOI divided by purchase price. Cap rate is 100, so the formula, 100,000 divided by $1 million. All right? Essentially, that's a 10% return. Okay, remember, essentially the rate of return you get, if you paid cash and didn't have a mortgage. The rate of return, your yield, your cash flow is essentially that net operating income, because that's the money you would use to pay a mortgage. If you didn't have no mortgage, that's the money that is yielded to you. That's your money that you pay. That's your profit pre-tax. You pay some tax on it, but that's the money that comes to you. All right. That's the percentage return of the building. That's what the building generates. So that's our cap rate. Couple key rules of thumb. The higher the better when you buy. The lower the better when you sell. So you want to buy in a time when cap rates are higher in general, meaning that you're going to make more of a rate of return. And when you sell your property, you time it right. You want to look at the market timing when you sell, because you want to sell during the environment when cap rates are lower, when investors are willing to take less of a return just to get in that building, and that's when the market's hot, right? When the cap rates are higher in the marketplace, the market's a little bit softer. So in the commercial world, we're entering into that now. We haven't seen major distress yet, although there are a few foreclosures, commercial foreclosures that popped up in Stockton, Sacramento, and Oakland since August, as I figured they would. Not many residential foreclosures popping up there, but there are a few commercial. So we're going to see higher cap rates in the very near future, which means better buying opportunities. Okay, remember, it's better to buy when the market's soft than to buy when the market's hot. Okay, sometimes you just got to buy to get in. But if all things are considered, if you can buy when things are down, you can get at a better price. You may have to tough it out for a couple of years, but on the back end, you're going to see a lot of growth. Okay, if you buy when it's hot and then the market goes down, it's going to go down. It's going to take a longer time to get your equity back. All right, so remember, the higher the better when you buy, the lower the better when you sell. A couple rules of thumb. Now, especially when you're investing with a group, because you got to spread the wealth. So you got to make sure that the building generates cash flow at a strong cap rate, okay? Not at a cap rate where you basically barely paying the mortgage and there's no yield for the investors. You have to make sure that you guys are paying yourselves. Now, some people will say, we just want to make sure it pays the mortgage. If it pays the mortgage in a good day, on a bad day, that means it don't pay the mortgage. What I say is make sure it generates a positive cash flow on a good day. So on a bad day, at the very least, it covers the mortgage. You dig? Because if you covering the mortgage in a good day when things are its best, One little false move means you're negative, meaning that you got to cover the mortgage outside your pocket, not the building. And you don't want to, you want to avoid that like the plague or like the corona. As much as you can, do not get a building that is that is negative cash flowing, that you're having to come out of your pocket to pay for. That's nobody likes doing it. You basically you're paying to do a bunch of work and take a bunch of risks. Okay, that's why this piece is very important. That's why I wanted to talk to y'all about this first before we get into more of the high level group investing things, which I'll come back and talk to you guys about. But I need to plant this seed. I need to drive this home because as we're transitioning marketplace wise, a lot of people are going to be excited and they're going to forget about the numbers. And I'm already seeing that. I've seen that time and time again. That's why I'm real. And I'm the guy who gets paid to close that deal, right? I'm telling you, be diligent about it. Don't just go out there and buy it because it looks good. Buy it because the numbers dictate that. Make sense? And I wanted to really just drive that home. So, a couple other terms, net cash flow. Now, that is the cash remaining after all expenses and the mortgage is paid. Most of us are not going to pay cash on investment property. We're going to, if we got the cash, we're going to have some kind of mortgage on there. And so the net operating income comes in, you pay your mortgage payment. Now what's left over is the net cash flow. The cash on cash return is basically the measurement of performance for that net cash flow. So you take your net cash flow divided by the total cash invested. And that total cash invested includes your down payment and your closing costs. Remember closing costs, y'all. Everybody forgets about closing costs and their client gets to the table and it's like, whoa, wait a minute. What's this? Closing costs. So you take your net cash flow divided by your total cash invested, and that gets you your cash on cash return. Okay, the net cash flow is a smaller number. The total cash invested is a bigger number. And you want to shoot for something double digits. You want to shoot for 10%. Now, our marketplace is very different. Even in Stockton, where the cap rate's a little bit higher, because cap rates, I'm still seeing stuff in 5-6% cap rates in Stockton. So it's at a 6% cap rate. Let's say you got a 4% interest rate on your loan, you're going to be making about 7.5 to 8% cash on cash. You're not going to be making 10. So all things considered, everything, the market's changed, but you want to make sure that your cash on cash return is higher than your cap rate. So if the cap rate for the building is 6, you want to make sure you're making more than 6, meaning that when you get a loan, the interest rate is lower than the cap rate, so you're making money on the bank's money. You want to make money on the bank's money. If you're going to take this risk, buy this apartment building, buy this commercial property, you want to make sure you're making money on the bank's money. So your cash on cash return as a rule of thumb should be higher than your cap rate. So if you got a 5 cap rate, you want to at least get 6.5% cash on cash return. You got an 8 cap rate, you want to get a 9 or 10% cash on cash return. It should be higher, not lower. And the internal rate of return, more of an institutional measure, but I'll break it down for you guys. It's the total return. Total return meaning including cash flow, including principal pay down, including any appreciation, including either the tax liability or benefit. Okay, that's what I mean total return. Real estate's a great investment because you get returns in multiple ways, not just cash flow. Cash flow is the key though. So internal rate of return is the total return on the initial investment on an annual basis once the property is sold. Meaning that we look at, okay, 5-year outlook. Property is going to make X amount every single month or every single year. Property is going to pay down the mortgage X amount every single year. We expect the property to go up or down X amount over a 5-year period. And during that period of time, we have to pay X amount of taxes. You take all those figures and roll them and annualize them out over that period of time. That gets you your internal rate of return. Not that big a deal for the individual investor, but I always put it in there because, yeah, you might be an individual investor, hit a home run, and all of a sudden you're rolling. And when you start rolling, you need to be looking at the IRR. If you hear someone say IRR, that simply means internal rate of return. Okay, it measures all the ways of making money on a deal over a period of time so that you can evaluate this deal versus the next deal. Okay, well, all these measures are just ways of you looking at this deal. How does this deal stack up to the other deal? Because if you're going to invest your money or you're going to put a group together and you guys invest together, you best better make sure that that's a good deal. Good deal in relation to what else is out there in the marketplace. Make sense? Okay. How much DD longer do we got? 5 minutes, 10 minutes, 15? What would you say?
About 10, 15.
Okay, perfect. It's perfect timing. So now I'm gonna give you guys some examples, and then we'll leave it some room for some questions. As we're talking about putting your group together, you've got to make sure when you put it together at the beginning, you do your pro forma, that you make sure that you let, first of all, let them know this is a projection, so I'm projecting this. We don't know what's coming at us next year, but based on the history of the past, this is a projection, a reasonable expectation of what's going to happen in the future. And we're going to share in these economics. Now, how you share, you can break it up in a bunch of different ways. I'll get to that on the next one. But you want to make sure that it's understood up front that there is going to be a sharing of the economics in here. You know what I mean? That's why it makes sense to really figure out what the cash on cash return is and what the cap rate is, so you can have a reasonable expectation of what you guys are going to make. In other words, somebody says, "Hey, I'm going to put up 100 grand," and you're saying, "Okay, we estimate it's going to yield 7%." It's cash on cash. So for every dollar invested, that dollar invested should yield 7% cash on cash. Meaning you put up $100,000, you're looking at $7,000 in a year, annually in the year. So you want to make sure you communicate that clearly to them up front, and everybody knows that is on the same page. Because when the money comes in and people are like, "Hey, well, I think I deserve X amount," you have to make sure that it's understood that for every dollar in, it's going to generate X amount of return based on your projection. And here's just an example of how you calculate first cash on cash return. So you take your annual net cash flow, right? The number we just talked about, net operating income. Now you paid your mortgage. What's left over is your annual net cash flow. You divide that by your initial investment. So let's just say, for an example, your annual cash flow was $15,000, and your initial investment was $100,000. So the math works like this: you take the 15,000 divided by 100,000, you got 15%. That's hard to do in California right now. 10 years ago, I was all day long. It was even more than that. It was all day long. And that's why I say, you want to make sure that you understand, yes, this is Northern California, even in Stockton, is expensive relative to the rest of the world. Even in that vein, things are going to fluctuate. Okay, there will be a time where 15% again may be the norm. Right now, you're getting 8%, you're doing good. Even in Stockton, 8 to 10%, you're doing really well. So you just got to make sure you figure out how to calculate this, and then figure out how to present it to everyone else. And I already kind of told you guys this: if you can get double digit, meaning 10% or more, excellent. That's what you're going for. But the bottom line is you need to make sure your cash on cash needs to be higher than the cap rate going in. Very, very important. Now, this is a key for, I want you to think in terms of a portfolio. Part of what we're talking about is building a portfolio, not just buying one property, all right? Or not just sitting on one property forever, okay? There's multiple ways that you can tap into the equity of your property's growth, your equity growth that your property has had, to buy another property. Either through refinancing, taking out some capital, bringing in equity, selling off a percentage of the property, taking that proceeds, buying something else. But one of the great methods of building wealth is through 1031 tax deferred exchange. When you sell an investment property, you defer paying the capital gains taxes. You take those gains and you buy something else. And it's basically like Monopoly. Four greenhouses, you turn them in, exchange them for one red hotel. That's a big way. If you ever played Monopoly, that's a great way for you to take control of the game and win. Well, it's a great way to build wealth as well. And can you imagine, you put two or three together, and y'all buy a fourplex, right? And let's say in this preview, let me just see if I can go back. Let's say you guys came together, four folks. Four folks put up $25,000 a pop, right? That's that 100,000 initial investment. Making 15,000 on a year. Pretty dang good, by the way. Okay, you put your 100,000 up, it grew. All right, now what we're gonna do is we're gonna look at what the return on equity is for this property. Okay, so you took your 100,000, you bought this fourplex, you held it for 3 years. Now that property's value went up. So we do an analysis to figure out what are you making on your equity. Okay, so we look at the property's net and the annual net cash flow, again, that 15,000 number. We divide it by the property's net equity. So let's just say you put that $100,000 down, you bought a fourplex of 200,000. That fourplex grew You know, now maybe that 200,000 is 400,000. So you put $100,000 down, it's worth 400,000. Your 100,000 of cash, right, becomes 300,000 of equity, right? That's why we love real estate. It goes up in value pretty significantly when we time it right. When we time it right, okay? So now what we're gonna do is figure out what our ROE is. We take our 15,000, or which $15,000 annual net cash flow. We divide it by the property's net equity. And in this example, we see, well, we were making 15,000 on our 100, and 15% on our 100 grand. But our 100 grand grew. If we were to sell today, we now have $300,000. And we're only making 5% on that. So the question is, if we took that 300,000 to the marketplace, what can we do with it? All right. This is a great way of building wealth, especially if you guys, a small group, you put your nickels together and you make something happen, you do some things right. Now, again, you put your four people with 2,500, 25,000, 100,000, 100,000, with 300,000. Everybody's 25,000 triple, right? And we was making 15% the whole time. Now what we, and I'm gonna go to the next slide, but let me just say this. As the property goes up in value, your return on equity diminishes unless your cash flow goes up in value at the same rate that your property goes up in value, which really rarely ever happens. The general rule of thumb, ROE diminishes as the property appreciates in value. So as properties shoot up in value, you know, your return on that building equity typically goes down. And then that widens the possibilities for taking that equity and doubling it up, tripling it up, expanding your cash flow, okay? Here's an example of how you can build great wealth. And you start with four, put your $25,000 together, you bought your building. You did this analysis. You came and talked to a broker, or you are the broker, and put this together, you did your own analysis and said, if we were to take this to market, here's two things. We think we could sell this property quickly. Remember, it was a fourplex we bought for 200,000, put $100,000 down. It grew to 400,000. We said, the market's hot. We can sell this property pretty quick right now, right? However, market's hot. We got to buy something. It might not be. It's going to be tougher to buy something. All right. So we look at it and say, all right, when we put this 100 grand up, it made us 15%. Great. Property went up in value though. Now that same 15% we making is on a higher number when we look at it from an equity standpoint. We're only making 5% on our equity. All right. And we determined that even though the prices are up, we can sell our property fast. It's going to be tougher to buy a property, but by looking at the market, we figure it still makes sense. Okay, so what we decided to do is sell and do a tax-deferred exchange, not just sell and pay the taxes. When you do a tax-deferred exchange, all the capital gains taxes on that growth. So you bought it at 200,000, it grew 400,000. You're going to pay taxes on that 200,000. You know, give or take the fees and costs, cost of selling the property. You're going to pay tax on that if you just cashed out. If you guys come together and say, hey guys, we did well in this. Let's go to the big leagues now. All right. Now what we're gonna do is we're gonna do this tax deferred exchange and take this 300 towards a new property. Now remember though, here's the caveat: the market went up, so we're not gonna get. When we bought this property a few years ago, we were used to getting 15%. That's what the marketplace was yielding. Now, because the marketplace the prices went up. Remember, cap rates are down, cash on cash returns are down. The marketplace saying, hey, if we do something, we're only gonna make 10% on our money invested. All right? But here's the magic of it. We're making 10% on a bigger number. Because when we sell, remember, we made this 300,000. We took our 100, turned it to 300, tripled up. Now, even though the market's hard, it's hot, and we can't get the same rate of return we got a couple years ago, our rate of return's down only 10%. If we were to take that, you know, now 300,000 and invest it with an expectation of only making 10% of our money, the net effect of that, 10% on 300,000 is 30,000. I have doubled my cash flow in one move, and I deferred taxes.
Mhm.
All right, that's the key to building great wealth. Right, not easy though. I have videos on 1031 exchange. I'm involved in 3 of them. It's a lot of work. I'm actively involved in 3 right now, in which I'm in contract with a couple buildings in Stockton right now. I sold a 17 unit in Oakland. We got a 15 unit and 9 unit building, and we're looking at a 46 unit building in Stockton right now, as part of these exchanges. If my client goes, she will have gone from 17 units to like 50 something units in one move. Okay? In a marketplace that was, pretty tight. It's softening up a little bit, but it's pretty tight to buy stuff. So this is what you can do when you're sitting here talking about, I ain't got enough money. Uh, I can't put no $100,000 down. Can you put 25,000? 3 other people who can do the same thing. Can you come together? Can you be a leader? Right? Because doing all this, I mean, it sounds great. It's seminar work, but if you can't be a leader, if you can't work with people, you can't deal with people, you can't pull this off. That's part of the skill set as realtors, and why you be part of the realtors, because you can develop that, especially if you be part of leadership. If you can run a realtors board meeting, you can put a group of investors together. We be arguing, you know what I mean? We be arguing because realtors are passionate about the community. So if you can, seriously, if you can do that, you have what it takes to put this together. And this is what our community needs from us, seriously, okay? And then just a couple bonuses here. You want to look for properties where you can create value, all right? Because in that creation of value, you can significantly pop up the equity. And when you don't want to just depend on the marketplace. Dee, let me know when I'm done. But you want to find property. Okay, okay, and we'll leave you for some questions too. You want to try identify properties that have issues with vacancy, or property managers ain't doing like this. We're looking at a building, I think it's on San Joaquin, and buildings in the area, everything is full, but this building's half empty. And I'm sitting there like, why is it half empty? I'm looking, we walk through, there's 2 units ready. You can move in there tomorrow. Sitting like, why? It's a hot rental market. Why are these sitting vacant? Because the property manager is not on their job. So it's sitting vacant. You know what I mean? Is there a way to build other income? Can you put a vending machine? Can you put a billboard? What can you do? All right. And can you increase the rents? Now here's where, as a landlord, my philosophy, the income determines the value. So you want to get your rents up. But I don't believe in gouging people. I believe if the rents are at 1,200, I like my rents to be 11, maybe 11 and a quarter, so that you're giving a little bit of, you're giving a deal to people and you're not squeezing people. I think that's an important part of the economic sustainability. Yes, the rents are up. Yes, you want to maximize your cash flow, but you want to do it in a way where you're operating based on a principle of, hey, I'm giving value to the other party. I'm giving value to the tenant. They may hate you. They may not pay your rent. You are giving value. And if you operate by that principle, it's going to pay you back. And particularly when you operate by that principle, you always keep your buildings full. You may have 3 or 4 people fighting over one apartment. That way you take your time and diligently figure out who the best tenant is for that apartment. In doing so, we'll cut down your vacancies. We'll cut down your time to lease, cut down your concessions, and help you be able to run a building more efficient. Okay. Also, find ways to reduce the operating expenses. Can you go solar? Can you change out the PG&E bills? Can you bill people back for water? Because in doing that, all that increases the value of your property. Right. Now to talk about that real quick. I want to end on this. Also, whether you're in a group or yourself, I think I'm seeing this now, and we're going to see more of this. Creative financing. Lease options to buy, master lease options to buy, land contracts, contracts for deed, wraparound mortgages, seller carries first and second deeds of trust, joint ventures, crowdfunding, raising capital for bigger deals, preferred equity, mezzanine structured finance. These are creative ways of financing a property, either if you don't have all the money down or if you're not able to get bank financing. This is becoming popular right now. I'm working on two deals in Stockton where the seller's willing to carry financing. I'm working on a deal in Oakland where it's a master lease option on a hotel, and a couple other potential joint venture deals. This is going to be very popular in this marketplace. I've got 2 videos on creative financing. You hit it up on YouTube, Infinity Investments on YouTube. Dial into that because that's what's coming. And if you know how to, and look, Agents, you can get paid on this. A lot of real estate agents say, oh, they're trying to lease out and I can't get paid. Yes, you can. And you watch them videos where I talk about how to get paid as an agent. A lot of agents, they don't understand that they can get paid, so they just blow this stuff off. You're going to need this tool in your toolbox. You can get paid, and you can buy properties using these strategies and tactics. So I hope it was real. I hope y'all got some value out of this. Seriously, I would love to come back and talk to y'all with the next level of the presentation about getting into the nitty gritty of group investing. But I wanted to just show you an outline of what's possible. And I wanted to drive home the fundamentals, right? I'm very involved. I coach youth football, when we're able to do that stuff, but in doing so, I tell the kids, the game is about blocking and tackling. All the exotic plays and all that'll come down the line. But if we can't block, we can't tackle, we can't win. Basketball, we can't play defense, you can't rebound, can't hit your free throws, you ain't gonna win. In real estate, if you can't connect with people and you can't talk with people and you can't negotiate, you can't say, you ain't gonna win. So we have to master the fundamentals of investing, take some leadership and coordination of putting people together and go forward, eyes wide open, because there's huge opportunities that are about to be in front of you. It can't be like what happened the last time. When the market crashed, I was telling people you can buy this house in Oakland for $50,000 house, right? You can buy a fourplex in West Oakland under $200,000, which is now over $1 million, well over $1 million now. And I can't tell you how many folks and how many black folks was like, I'm not investing in that neighborhood. Ooh, I ain't going over there. We need to look beyond that. We need to eyes on the prize. We need to put our people in homes. We need to put our people in investment properties. We need to put ourselves in home investment properties. And the time is now. Be diligent though. Don't just go for anything. Make sure it's a good deal. But that's all I got. I hope it was helpful. Hope it was a blessing. Hope you was able to take something out of there. Do we have any questions? I'm gonna stop my share.
So thank you, Steve. That was actually very helpful information for me. Does anybody have any questions for Steve?
I just had one. I saw his email and his phone number on the screen, but I didn't get a chance to write it down. Can we show that again or say it, please?
I'm sorry, say it one more time. It was breaking.
I saw your phone number and email online. I see it now, but I wasn't able to jot it down fast enough.
Oh, okay, yeah, no problem. Yeah, so the office number is 510 675 7755.
Perfect.
And then the best, if you hit me up on YouTube, if you go to Infinity, go to YouTube and put Infinity Investments, you're gonna see my station, subscribe, and then on almost all my videos, there's a link where you can, if you want to talk to me at length, you can book a time to where we can sit down or Zoom. We can't, once upon a time we'll be able to sit down and have some lunch or some coffee or something. At least we can get on this Zoom thing and make it work if y'all want to sit down and chop it up. So, but thank you.
Thank you.
So I have a question, like if you have a group of people and as far as getting approved for like a loan, I know a lot of group investors who are just starting off, they worry a lot about their credit like you would like a traditional loan. So what would be your advice as far as what they should focus on to be able to get approved?
Well, you can absolutely do it. It's possible. Now, in the world of commercial real estate, it's more possible. In residential investment finance, not home owner financing, but in 1 to 4 units investor loans, it is even still hard to get a loan when you have an LLC on title. It can be done. I've done it. I bought and then refied fourplex in our LLC. We had to do all kind of stuff though. Because most residential lenders, even on an investment loan, want it to be in a person or person's name, but you want it as much to be in an LLC when you're running a business like that. Now, in the world of 5+ units or more or commercial, it is way more typical for people to buy as partners, as members of an LLC. And so what happens is typically they will look at all of the partners who have 20% or more of the deal. They're going to underwrite them. So if you're not underwritable, you may have to be under 20% of the deal. You might have to be 19.5% of the deal. All right. And in that type of situation, if you're putting up all the cash and not getting financed, You might be able to say, hey, I'm 30% or 40%, but I'm not financeable. However, I'm putting the cash. And then the banks on a case by case can understand that. Most general rule of thumb though, they want anybody with 20% or more of the stake in the deal to be on the hook for the loan. And so but if you're under 20%, you don't have to be on the hook for the loan. Generally, they're going to underwrite who is the majority owners and make sure that they can get finance. So that being said, as somebody want to put this thing together, you want to make sure you find somebody got some quality credit standing and ready, and not just credit, by the way. In the world of investments and commercial, they are looking at your global cash flow and your personal income and expense. If you own properties, all the properties that you own, income and expense. And they're looking at your balance sheet, what the assets and liabilities that you have, just like any other lender. But they're putting an onus on you, and more importantly, they're putting the onus on the property. They're going to look at the property's historical income and expenses and really go through that and try to make a determination whether they can do lending. But if you have bad credit, if you're not financeable, you still can get in the deal. If you find a deal, you bring people with ability to get financing, you bring people in who got the capital, but you might have to take a little bit of a back seat in terms of the ownership percentage, because if you are over 20%, typically they want you going to be on a loan. So that's kind of the guidance on it. But it can be done, and it's done every day of the week.
Now, do they take into consideration, like, for a multifamily unit that's 1 to 4, they may take into consideration the income rents that you're getting from that and apply it to, your approval. Is it the same with commercial or?
Yeah, and it's more because in my understanding, in 1 to 4 units, they'll take 75% of the rents.
Okay.
Like I know a lot of people when they're buying fourplexes, they'll take 75 now. Now it's a little bit different. If they're going to live in one of the units, they take 75%. That's why they take 75%. That's in fourplexes at least. Duplexes might be 50%. But if it's a like fourplex that you're not going to live in, or it's a house that you're only going to rent out, they will look at all of that rent in combination with your income and expense. On a commercial, they also are looking at 100% of the rents. And they're really looking at the net operating income, because guess what? That's the money you paid the mortgage with. And they're not going to finance you if on paper you got to come out the pocket. That no bank's going to do that. On paper, you have to be. That's why I'm saying you don't want to go in and say, hey, we just want to pay the mortgage. Because that on a good day, if you just paying the mortgage, that's all right. On a bad day, that means you upside down. You lose money. And you don't want to plan for that. That could happen. It's part of life. It's part of business. It is what it is. You want to plan to make money in a good day and break even on a bad day. And that's why the lenders are looking at it that way as well.
Okay. And then I have one more question, and I'll let somebody else go. If you're buying, say, a mixed-use property and there are some vacancies, say, like in the commercial part of the property, when you're analyzing it, are you analyzing for the projected rent, or are you analyzing for what is currently being paid?
So yes, excellent question. Both essentially. So you're going to look at what is actual, all right, and then you can project what is the market rent for that vacant unit. However, the financing is going to be based on what is. You can now. Every situation is different though. Before the pandemic happened, in apartments, let's say, and you say you have a retail on the floor, got 10 apartments upstairs. That, especially in a hot rental market, if you had vacancies, they actually was okay with that, because you can go out and rent at a higher number, especially in rent control areas, right? If you got a vacancy in a rent control, that's the best thing going in a strong rental market. As the tables been turned, we're finding now they don't like that no more. They're going back to traditional. We want it to be occupied. The commercials, and we're lending off what is, not what could be. So that's the shift in the commercial industry, real estate industry, financing wise, that we've seen since the coronavirus. Because the last couple of years pre-coronavirus, lenders were lending on vacant properties, or properties that have a lot of vacancies, and they were confident about it. They were excited about it. They were not, hesitant. Now they are, because it's harder to rent up units now. So that's a big shift. Now, for purposes of your analysis, you want to look and project, hey, if this commercial space is vacant or this apartment is vacant, what can I get for it? And know that that's possible, but know that you got to do some work to get to that point. If it's totally rented out, I mean, it's totally renovated, ready to go, you got to do some leasing work. And that's tough, right? It's possible, but it's tougher. So you need to know what is, and they're going to finance you based on what is. And then you need to know what's possible. And say, if I can make this move, this is what I'm looking forward to. Now we can move towards that. But the financing is going to be based on what it is today.
Gotcha.